You've been deferring taxes your whole career. What nobody told you is the IRS set a timer. And when it goes off, you don't get to decide how much you pay. So if you have money saved in a tax deferred account like a 401k or IRA, you're either going to have a tax strategy to minimize those taxes or a tax bill to pay those taxes. Hi, I'm Nico, and for 16 years, I've helped families think more clearly about retirement. By the end of this video, you're going to understand what you need to do to potentially avoid tax time bombs in retirement. Let me explain how this works because it's actually pretty straightforward once you see it. But most people never see it until it's already happening to them. When you contribute to a traditional 401k or IRA, you get a deal. You don't pay taxes on that money now. It grows tax deferred, sounds great, and for the accumulation phase, it is great. But here's the part of the conversation most people don't think about. The IRS isn't forgiving those taxes, they're deferring them. And they have a plan for when they collect. It's called a required minimum distribution. And it starts whether you want it or not. Starting at age 73, the government requires you to take a minimum amount out of those accounts every single year. It's calculated based on your account balance and a life expectancy table. You don't get to choose the amount, they do. And you don't get to skip a year. And every dollar you take out gets added to your taxable income. So, why is this a bigger problem than most people think? Here's where this gets real. Most of the people we work with have been diligent savers their whole lives. They've maxed out contributions, they've let accounts grow for decades, and by the time RMDs start, they can have very large balances in those accounts. And the required distribution can be significant. We're not talking about a small line item. For most affluent households, RMDs can push them into a higher tax bracket than they were during their working years. And they're not spending the money because they need to, they're spending it because the government is requiring it. And it gets compounded. Higher income from RMDs can trigger higher Medicare premiums through something called IRMA. It can affect the taxation of your Social Security. It can push capital gains into higher brackets. They're all related. So one forced distribution creates a cascade of tax consequences that most people never planned for because nobody told them it was coming. See, time doesn't fix problems. It reduces the options we have to fix them. And this is one of the clearest examples I know of where waiting makes the options smaller. Here's the good news. There's a window. And for most people who retire before RMDs kick in, it's a real, meaningful window where you can actually do something about this. It's called a Roth conversion. And the concept is simple. You take money out of your traditional pre-tax accounts, pay the taxes on it now, and move it into a Roth account where it grows tax-free and you never have to take required distributions ever again. If you retire at, say, 62 or 65 and your RMDs don't start until 73, you may have 8 to 10 years where your income is lower than it was during your career and lower than it will be once RMDs start. That window is potentially the best tax planning opportunity of your entire financial life. Most people don't use it. Not because they're doing anything wrong, but because nobody surfaced it as an opportunity. The people who are proactive about this can save meaningful amounts in lifetime taxes. We're not talking about hundreds of dollars. We're often talking about tens or hundreds of thousands of dollars over the course of retirement. However, an incorrect Roth conversion strategy can be as expensive as not having one. So I want to give you a quick picture of what this looks like in practice. Hypothetical numbers, but representation of what I see regularly. Person A retires at 64 with $1 million in a traditional IRA. They don't do any Roth conversion planning. And by 73, that account has grown to $1.4 million. Their first RMD is roughly $55,000 on top of Social Security, on top of other income. Their tax bracket goes up. Their Medicare premiums go up. They're paying more in taxes in retirement than they planned. Person B has the same starting position, but they work with someone who identifies the conversion window. And over 8 years, they convert strategically. Not all at once, not the same number every year, but strategically. And by 73, their traditional IRA balance is significantly lower. Their RMD is smaller, the tax bill is smaller, They have a Roth account that passes to their kids completely tax-free. Same starting point, two very different outcomes. And the difference was a plan. I'm not telling you this to create anxiety. I'm telling you because this is a fixable situation if you know about it early enough and have a strategic plan to fix it. Remember, what got you here may not get you there. The strategies that were right during the accumulation phase are often not the right strategies in the distribution phase. The tax conversations change completely in retirement. And the advisors who are doing this job well are actively managing that conversation, not just managing a portfolio. If you're within 10 years of retirement and you haven't had a real tax strategy conversation, not just a tax filing conversation, it's worth doing so now, when the window is still open. If you want to understand what your current tax exposure looks like in retirement and whether you have a window to do something about it, that's exactly what our Retire Forward Readiness Assessment looks at. Link is in the description.